Welcome back, everybody, to the weekly market review for the week ending October 4th, 2024. We are now in the fourth quarter of the year. Hard to believe that we're at this point already. And man, what an interesting week. After a September if you look at the S&P on the monthly chart, after a September that was up 2%, and what is usually seasonally the worst month of the year, has given way to October, which has been very interesting. So we finished September on a strong update at the beginning of this week, and the very first day of October, markets decided they wanted to go down, and then they ended up finishing the week. It was interesting going through the rest of the week. Wednesday kind of was down and then sort of closed kind of up, like barely just a hair up, and then went down and up and down and up, and then closed slightly down yesterday. And then today the big news was the jobs report, which crushed expectations. You see here on this Yahoo Finance article, and you can kind of see their little rundown of the big parts of the payrolls report. So you had payrolls beating by over 100,000 jobs, unemployment rate falling to 4.1%, average hourly earnings coming in higher than expectation. Just a monstrous, surprising, strong report. And, it was really interesting because when you look at the price action from the day, actually, let's look at it on the futures. It's kind of fun that way. You actually saw, here's the data release at 5:30. You had a big spike up, kind of sold it off in the first couple of minutes after, and then 5:35, 8:35 in the morning Eastern time. I'm on the West Coast, so I always look at it on Pacific time zone. And then it just kind of went up, and then right around 9 a.m. Eastern time, 6 time Pacific, kind of peaked and then started to kind of give it all back. And then once the markets officially opened, it really kind of stayed there for a little bit. Then it really sold off right around the 10 o'clock Eastern hour, and by the time, in less than that, during the 10 o'clock hour, bottomed and kind of just bounced a little bit, started to come off, bounced a little bit, and then really took off towards the end of the trading day. And one of the things that's interesting is we did at least in the futures, let me see if so we did on the non-futures, so the regular S&P index, we did close at a high, but on the futures, it's interesting to note that we barely, wicked above the high from the morning prior to the market open, prior to the New York Stock Exchange open, and then we didn't close because the futures go about an hour beyond the New York Stock Exchange normal closing time, and it didn't close above those highs. And I think that's kind of interesting to note. And I also note, too, that it tried to get above during the last 5 minutes of the trading day on the futures prior to the NYSE closing, and it kind of gave most of that back before market close. So I think that's kind of interesting. But in any case, if you just kind of look at the week, it just kind of it's interesting. It's hard to really know kind of what to make of it. Going back to, I'm on the 10-minute chart, going back to, the Thursday, right after the Fed meeting, where we had, the market had kind of gone up on the 50 basis point rate cut, gave it away, and then the next day just boomed. And we've just kind of been sideways since then. We haven't really it's up, but it's not up that much, given that it's been a few weeks. So we spent the better part of 14 days or maybe more chopping around these levels. So it is interesting to note that. But if you just look at this week, you can kind of see the up and down, up and down, up and down. And it's hard to know really what to make of the price action. If you look at it on the daily chart, then to me it looks pretty bullish, honestly. There are a lot of people out there that are looking at the 2007 analog. They're looking at the 50 basis point rate cut. They're looking at the market making new highs, the market going up on a payrolls day following the first rate cut. And people are looking for that parallel. And I'm not saying that it will happen, and I'm not saying it won't happen, but it's not the same kind of price action, because if you actually go back to 2007, everything, I mean, it looks different, and even the market behavior on the Fed cut day, and then the market behavior on the non-farm payrolls day, which, you know, actually to the credit of those who have been looking for these for this analog, or looking at this analog, it is important to take note of the fact that in both cases you did have a very, very, very surprisingly strong payrolls report on the heels of that rate cut. It's because basically ever since, you know, July and into August, people have been worried about growth, and despite that worry, stocks are still up at highs, and so there's that to consider. But I mean, to me, this looks actually, I'll put a line on the chart. You can kind of see what I'm talking about here. If you, sorry about that, hold on. You can see where this green line has showed up here. We basically, that was the breakout point from the July highs. And of course, a few weeks ago, we broke out from that, and we just have basically retested that. And there were a lot of people who were saying, oh, you know, the breakout didn't hold. And it's like, well, actually it did. Just pull up a chart and look, draw a line and look. And so I don't feel like this is a market that's rolling over, although a lot of people have been suggesting that. And there were a bunch of times, if I go back to my 5-minute chart here, actually let me go to a 1 minute, it's a little bit more fun to look at. There are probably a whole bunch of times along the way that all these people have been looking to sell. People probably sold at the bottoms here. Anyway, stocks look fine. I mean, honestly, if I go to the NASDAQ futures, what I would call out here, the positioning does not support what I'm about to say. But I am wondering about this reversal, this outside reversal candle from Tuesday of this week. It'll be interesting because we've had outside reversals before, although I don't see them on my NASDAQ chart. If you go to the S&P chart, you see them a few times. You don't see them very much on the NASDAQ chart. Actually, let me do some adjustment here. Oh, I can't. I don't know what's going. Oh, here we go. Sorry. You know, just a few reversal candles, but it hasn't really meant anything in the long run. So I do want to just mention that, and that was with the adjustments and settlements, stuff like that. This is actually the first outside. Actually, wow, this is pretty crazy. This is the first outside reversal candle since going back to around the lows. So I guess you have to take into account that happened at the lows. So this doesn't necessarily mean that we're going to roll over, but I'm just saying it is rare. So like I said, the positioning does not support this, but if you were interested in trying to go short with clear risk to reward, then the top of this reversal day, you know, once you get to the market open on Sunday night, Monday morning, you know, this would be the stop loss point where you know you're wrong. Or you could just go to the wick high right here from September 26th. You could do that as well. It is interesting to note the Russell is still having trouble getting above these highs. You've seen now a couple of knocks at this, you know, 2290 level. The Russell positioning is very overextended, so I do want to highlight that, because if any market is set up for downside or limited upside, it's probably the Russell. So just kind of based on kind of where I see the markets, I mean, you have the S&P knocking at highs. NASDAQ's not quite there. It's still got a ways to go before it gets back up to highs. So you would, if you were pairs trading this, it would be kind of long S&P, short Russell, or maybe long Dow, because the Dow actually is kind of closing on all-time highs. So maybe long Dow, short Russell if you were going to do one, because the positioning dynamics are much more favorable. To me, the big story, which to me wasn't much of a surprise. Oh, by the way, I forgot to say at the beginning, you can follow me on Twitter at Mr. J. Thomason and my Substack at befinanciallyfree.substack.com. I forgot to say that at the beginning, but I bring those up. This is actually a great time to bring those up because one of the things that I have been talking about lately is the positioning in the dollar has been uber short. The sentiment in the dollar is uber short because going back to that Wednesday, actually this is really interesting. On Wednesday, the 18th of September, when we had the Fed meeting and they went 50 basis points, basically for a long time people have been expecting that the rate cut, the first rate cut or the start of the rate cutting cycle would mean dollar bearishness. And so I can't tell you, I mean, I'm not going to take the time to go look up on Twitter right now, but I can't tell you how many people, even some really well-known people that I follow, have been basically telegraphing, oh, dollar is going to go, DXY is going to go below 100, it's going to sell off, DXY is going to go to 95 or 90 or 85 or something like that. And people have been just counting down the death of the dollar, and then the positioning. And granted, you can't. Pretty much nobody except for a few people can actually trade the dollar because it's on the Intercontinental Exchange. But even the positioning on that, as limited as it is, was so like bearish. And then the positioning in especially the Japanese yen, and I'll get to that in a second because that's been kind of my highlight trade for a little while. But most of the other currencies they've been going very short U.S. dollar and long whatever the cross currency is. And to me, when you combine the positioning and the sentiment and the expectations, to me this was a perfect setup for a reversal. And what's interesting, and the reason why I called out that day, so you had the dollar sell off and then basically close nearly unchanged on that particular day, on the Fed day. And it's interesting to note because we've wicked around that area, but we have not closed below the low of that day. And here we are now, like in just a few days' time, we've gone from, tinkering around at 100.4. We're now over 102 on DXY. And to me, if you go to some of my little indicators here, these are the ones that I look at in my newsletter each week. So if you're interested in seeing this, you can check that out. You can go subscribe, and the links are in the description. But you can see the yellow. We've gone from red to yellow, so from bearish to neutral in the probable range indicator. It has come up pretty far, so I don't expect that we're going to get a whole lot of upside here on the move. But also, and more importantly, you can kind of see as over the last few weeks, definitely for the entire month of September, our bearish momentum was waning, and that's why the tide indicator right here is yellow instead of red like it was over here. And basically, what that was telling you was that the dollar to the downside, that whole idea was losing momentum. And you can see now we are green. So despite the fact that the tide is bearish, we are in counter trend momentum right now. And so and then because the probable range indicator is turning yellow, it means that there is room. It's not a guarantee, but there is room for the dollar to keep moving to the upside. And there are some ramifications for that. I'll talk about those actually right now, I think. One of the ramifications for that is equities. And I know that we had a good, strong move up today, but to me, the dollar moving up this week is probably part of the reason for the kind of the stagnation in equities this week. Of course, we also have had some geopolitical concerns. That's a little bit of a different story. I'm not going to touch that because geopolitics, you should never trade based on geopolitics. And typically, like, geopolitical escalations are usually very short term in nature in terms of their market impact. So, things will sell off. I mean, but then they come back. So, and equities are an example of that. I mean, find me the day this week where we sold off because of the geopolitical situation, and here we are back close to the level that we started the week at. So just pointing that out. So anyway, I think the strength in the dollar may have something to do with the stagnation in equities for quite a bit of the week. It also has ramifications for gold, and gold has just been kind of puttering around here. Let me turn these off. You can actually see they're both bullish, but gold's kind of pittering sideways. And what I do think is interesting is gold is really heavily positioned to the long side, so the positioning is really overweight, crowded. So there's one view that you could look at this, that it limits the upside. There's another view of this that you could say that, like when the dollar is having a strong week like it did in gold, like if you look at the weekly on gold, gold's only down $4.50, like less than 0.2%, but the dollar went up 2% this week. Tells you that there's a lot of strength in gold, so maybe the short gold trade is not a great idea. I mean, unless you have a system, like I have a system that I use to trade. So if the system says you have to do something, you got to do something. But you have to kind of juxtapose those things. So gold is showing some pretty interesting strength. I did think it was interesting that just across the day today, this is crazy. If you look, when the jobs numbers came out, just a dump in gold, small bounce, dump. We made it all the way back. We made it up to new highs for the day, sold it off, and then kind of pittered sideways, and then kind of came back towards the end. So it closed down, but not down nearly as much as it might have otherwise. So strong dollar could have ramifications for the metals. Although silver rallied today, and I think silver, it didn't close at its highs, but I think it rallied because it's an industrial metal for the most part now. Not really, it shouldn't really be a precious metal anymore. So I think that the strong jobs numbers, strong economic data was suggestive of, maybe that we would get. Sorry, I'm blanking here. Maybe that's better for the economy. That's showing a strong economy, and therefore, the industrial metals can go up. Except the problem with that is that copper was slightly up today in the futures market. So copper is really interesting to think about, by the way. And on that note, let me talk about the yen. Strong dollar means bad yen. I mean, the yen is getting crushed, and it's crazy because like a week ago, when I was on with you guys, I was talking about the huge move in the yen, and I wasn't really sure what to make of it because, I felt like the markets were like overreacting to the election, and so I ended up just holding my yen trade, which was basically at break even at that point. And then the next day, on Monday, going into Monday night or Sunday night, Monday morning, we tried to go up and then sold off and then sold off. And it's just been basically, other than Tuesday, it's just been all red all week. And now we're even lower than where we were going into that election. So it was a good thing I held on to that yen trade. Now, strong dollar means yen is probably going down. The yen was super crowded, and the crowding in the yen has barely subsided. This week is the first time since since I think July or early August, where the yen positioning did not get longer. It actually got shorter, but it wasn't by a whole lot. So there is a lot more, in my opinion, there's a lot more room for the yen to get sold. So the question is, where do you look for that? So we've got kind of some support on the futures. We've got support around, let's see, 0.0067. You've got some more support around 0.006645. If I go to the Fibonacci tool, this is kind of helpful sometimes. We're about to get to the 50% retrace. I would be watching the 618 retrace as kind of the spot. You can actually see that may have been resistance before. A couple of different touches there. So that's probably where I'm going to be watching for price to get to before I take profit. And I'll also be watching the positioning over the next week or two. I am of the opinion, this is one of those things, I wrote about this in my newsletter, you can be both bullish and bearish at the same time, depending on your time horizon. So I am long-term bullish, and I've written about this in my newsletter. There's been only a few occasions where the yen positioning switched like this, and they ended up being big-time turning points for multiple years in a row. So I actually think the long-term trend is going to be higher. So, but obviously every trend needs to establish new highs and and higher highs and higher lows in this case. So, and it's not just going to go up in a straight line or down in a straight line. So the way I'm watching this to come down, establish a new low or a new base right around here, and then it's going to bounce, and then it's going to make a new high, and then we'll establish the pattern of higher highs and higher lows. That's kind of what I think the long-term trajectory is. But for the time being, I actually think the general pathway is probably down to maybe about there. And this could take us into November, definitely a few more weeks into October. Could take us into early or mid-November, and it kind of just depends on what goes on with markets. And along with that, my question is the move in equity sustainable? Are we setting up for a correction just at the time where everyone is about to start saying that things are all clear? Because again, jobs data now seems to suggest that's what everyone's anchoring on. Jobs data seems to suggest that everything is fine. Equities are up. I wonder if this is going to be now. If this is going to lead to kind of another final sort of push into new highs, maybe towards 5,900 or maybe even 6,000, and then we might go into some kind of pullback or correction. Who really knows? I'm not going to forecast a huge crash or anything like that. I'm not confident enough or bold enough when equities go up over time, as you can see. So yeah, I would be watching for that. I am a little nervous about the crude oil move because to me it kind of feels like I've seen this a bunch of times. Actually, this is similar to my dollar chart. I didn't talk about this with the dollar, but you kind of have a similar thing where we actually touched the lower end of the probable range. That has been the low so far. We've come up really fast the last few days. We've got a probable range move. We've got counter trend momentum, and we kissed exactly the what's called the current line or the control line. And so to me, this kind of feels a lot like some of these other moves that we had over the last few months where, like, especially if you go back on my timeline on Twitter and go back to, 2023, there were a bunch of moments where it was all the supply story, there were geopolitical escalations, and we would get this pop, and then we would sell off. And then even when we moved above the tide line, like the sentiment and the positioning got so out of whack, that it wasn't good. So it'll be interesting to see because the energy complex has been actually, in this case, really short because of the recession fears. So I have not updated the positioning yet on in my systems on the energy space yet. So when I do, I'll be able to see more about that and report on that in my newsletter. But that might be a dynamic that's different. If people are super bearish, and I'll have to probably watch and see what happens with the next COT report next week, because with geopolitical escalation and with the strong jobs numbers, my guess is going to be that the crude oil positioning especially is going to change quite a bit. So I'll see kind of where that goes. And I think that's probably where I'm going to stop. So those are the things that I've been thinking about today. The opportunities continue to be in the yen and then I like potentially in the metals. I don't know if I'm super willing to advocate for a short metals trade just because of the situation. But wow, I can't believe I almost forgot about this. That's, I think, in my opinion, that when you come to the precious metals situation, I think the question is, so on a strong economic number, or that shows strong economy, gold should go down because because a weak economy, deflation is typically the type of situation where, or like the potential for more future rate cuts. That's usually the place where, that where you don't need gold anymore. So it's on weak data that gold goes up, or on geopolitical events. And this is kind of the other side to that coin too. So, and this to me goes back to the fact that gold positioning is really, really, really speculatively long, because how do we have all of this geopolitical stuff going on and gold is not at 2,700 or 2,800 or 2,900 or whatever? So there's an interesting battle going on here, because you have the geopolitical situation and the fact that the Fed did cut 50 basis points on the one hand, but gold didn't go up. And then you have the strong economic numbers. The ISM services numbers were really strong, and the jobs data today was really strong, and gold won't go down. So there's a really interesting battle that's taking place. So in that situation, it's almost like you just got to watch, the highs at 2680, and then the lows around 2625 or so, and whichever way it breaks, that's the direction you take the trade, and just kind of ride it there with a tight stop. So that's what I wanted to say. So all right, so I'll stop there. Thank you guys for tuning in. Hopefully this was helpful. Don't forget to hit the like button and subscribe, and check out my newsletter. I'll see you guys next time.